Okay, so I indicated to you that the balance sheet is where we present the assets, liabilities, and capital. And I think that we are all very much familiar with our assets, liabilities, and capital. But for the purposes of revision, I'll quickly go through the list. So in terms of your fixed asset, you have land and building, fixtures and fittings, motor vehicle or motor van, plant and machines, equipment, furniture, office premises. Now these are the tangible ones, the one we can see, feel, and touch. Those that we cannot see, feel, and touch, we have the copyright, goodwill, patent right, trademark, investment in intangible assets like shares, leasehold and freehold. Now, this leasehold and freehold, they are forms of renting, right? You rent somebody's property, okay, for a period of time, okay. The leasehold normally has a shorter period of time than the freehold, okay. So it could be land, it could be a building that you are leasing. It could even be some companies even lease office equipment like computers, printers, etc. And sometimes it's a better way of having an asset than going to buy it directly. Um, when you go to most of the banks we have in Ghana, they lease the computer, the printer that they use simply because they cannot afford buying those items, but the leasing give them the space to be able to make regular installment payment. Okay. Example is, you see, right now, if you ask me as your teacher to go and build chamber and hall, I can't afford building a chamber and hall now. Okay, so the option available for me is to lease it or rent it from somebody. Because if you do the renting, you don't pay the total sum, you pay them in bit by bit, monthly or annual. Okay. Then your current asset, please. These are your current assets. Your stock, which is the closing stock, sometimes referred to as inventory, debtors, sometimes referred to as receivables. Then prepaid expenses. I'll use your electricity bill as an example. You see, currently you buy the electricity before you use it. Okay. So if you go and buy and you haven't used it, it's your money, right? So prepaid expense simply means that you have paid for the expense, but you have not enjoyed the service or the product. Okay, and a typical example is the current prepaid electricity that we are using. You go and buy before you start using. Accrued income. Accrued income. So the incomes that were listed, like the investment income, commission received, rent received, sometimes you are due to receive them, but you have not received them. I don't know if that makes sense. For example, the business worked for or rendered a service for a customer. The customer is supposed to pay a commission and the customer hasn't paid. So we'll say that that commission income is accrued. And accrued here means it is in arrears or it is owing or outstanding. Let me write these things here so that at least you can appreciate. So when you hear accrued or accrual, we are referring to owings or due or outstanding. Or unpaid, as in you haven't paid it. Okay, accrual means you haven't paid. So accrued income means that income that the business is supposed to receive, but it has not been paid. And then our usual bank and cash will follow. So these are your current assets. For the liabilities, your current liabilities are the following: creditors, which are sometimes referred to as payables. Then we have the bank overdraft, the opposite of your bank is a bank overdraft where you withdraw more than what you have in your bank account. Then you have the accrued expenses, right? So accrued expense means that expenses that has not been paid or outstanding or due or in arrears or owing. And then finally, income received in advance. So this time, the business has received the income for which it has not done any work for. Let me give an example. If you are selling shoes and normally you polish your customers' shoes, okay, so they give you some commission. You see, the polishing of the shoe is not your major activity. Your major activity is you buy and sell shoes, but you render that other services to get other income. Okay. So your customers are supposed to pay you that commission for polishing their shoe. And this is what happens. Somebody has paid like for 1 year. He has given you money for polishing 1 year. Okay, but we are in the first month, January. So the money for February, March, April, May, June up to December, those income you have received is not yours. It's for the person. The person can come and say, okay, I won't polish my shoe with you again. So give me my balance. So income received in advance means that the business has received the income before performing or rendering the service or providing the product. I don't know if you understand. I want to believe you do. If not, ask questions. So these are your liabilities, and then the long-term liabilities, you know, your loan. But for the sole trader, is the loan. But when you move on to companies, you see bonds and debenture. Okay. Then the final thing is the capital, and then the drawings and the net profit. So these are the items that we arrange in the balance sheet. Now let's go to the format of the balance sheet. So there you have it. It has a title, balance sheet as at, and you'd reckon that is different from that of the trading and profit and loss account. They have a title for the year ended, and this one is having as at. The reason is that the trading and profit and loss account, we prepare it for just 12 months, okay? But for the balance sheet, it gives you information from the time the business started operation. Okay, so example, if the business started operation in say 2014, and then we are now in 2024, your balance sheet is going to give you your asset, capital, liabilities from that 2014, the balance on these asset, capital, liabilities up to now. But your trading and profit and loss account would only report for 1 year. So if it is 2024, only 2024. If it is 2022, only 2022. So that is why they have the different heading, asset, and then for the year ended. Okay. Now, the first thing you put in your balance sheet is your fixed asset. So if you look at this side, this is the skeleton of the balance sheet. The first thing is the fixed asset. After that, you follow with your current assets. And then you less the current liabilities from the current asset. So try to draw some, some uniqueness, or if I should say some learning, um, 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 learning codes. Okay. First, put in your fixed asset and then go and look at the current asset, current liabilities. We compare those two to get what we call working capital. And then the working capital is added onto the fixed asset to arrive at the net total asset. And this is the first section of your balance sheet. So please get the skeleton right. Fixed asset first. After that, you go and look for your working capital. Working capital is current asset less current liabilities. Okay. And then you add it to the fixed asset to get the net total asset. Confusion day, please. Let me pause. Ask questions, please. I beg you, because I know you might be confused or you have questions. Feel free and ask me. Frank, questions?
So is it necessary to add the working capital to the fixed asset?
Yes, it is very necessary, and it should always be the case that when you are preparing your balance sheet, you begin with your fixed asset first, okay, and then you go and look for your working capital, which is your current assets less your current liabilities. It should always be the case. So if you look at the broader picture, your fixed assets will come first like this, okay, and so your total fixed asset will be here waiting for you to go and pick the working capital. Okay, so look at the working capital. You start with your current assets, okay, and then you less the current liabilities to get the working capital, which is now added to the fixed asset to get the net total asset. Okay, so when you are given the question, you may not have all of the assets we have written here. This is just a format, right? But the assets that you have, you begin with the fixed ones, followed by the current assets, you less the current liabilities to get working capital. And please note the definition of working capital. It is highly examinable. Working capital is equal to current assets minus current liabilities. Note it down. You will need it sometime. Okay. So that's the first section of the balance sheet. Okay. After that, the final section is where you show the capital and then the long-term liabilities. Okay. So you begin with the capital, you add any additional capital because some of the sole proprietors, they bring in more capital as the business is moving on. So you add any additional capital, you less drawings because we know that drawings is what the owner took for personal use. So you less it from the capital. Okay, and then you add the net profit or net loss you got from your profit and loss account. Okay. Then finally you add the long-term liabilities, and I'm telling you for sole trader, it is the loan, bank loan that comes. So that is also the second section of the balance sheet. If you look at it in the broader perspective, this is how it looks like. So you begin with the capital, you add additional capital and net profit, you less drawings, okay, and then you add on the long-term liability, which is the loan, and then you get the capital employed. So if you are looking at something, you see that the capital employed should always be equal to the net total assets. Okay, they should be always equal. And if you get them equal, you say your balance sheet has balanced. And that's where student gets happy. They say, oh, my 10 has balance, my 10 has balance. If it doesn't balance, it means there is a mistake. So dear professors, you'd have to get familiar with the format of the balance sheet. Very, very important. But for now, I want you to get the framework. You begin with fixed asset. You go and look for your working capital, which is current asset minus current liabilities. And then you add on to the fixed asset to get the net total assets. Okay, for the first section. The second section, you look at your capital, you add net profit, less drawings, and then add the long-term liabilities. So I think I may have to put the format on the page for you, or you can also visit your various textbooks to look at it. Okay. But any other question on this for me? No questions? Okay, so let me quickly do a little of going over the balance sheet again. So when you see the broader perspective, you begin with the fixed asset, and normally we show the cost of the asset, depreciation. So I told you about depreciation. That's if the asset is losing its value or it is deteriorating. Okay, you have to present it in the balance sheet. So for example, if you bought a shoe for say 20 cedis, and then over the years, maybe you measure the value that has fallen. Okay, there are experts who do this, the measurement of depreciation, etc. And we have certain methods of depreciating an asset. So let's give, for instance, your shoe, we say, oh, it has depreciated by 5 cedis. Then the last column here, which you see NBV, representing net book value, is the difference between the cost and the depreciation. So that will be 15. So the net book value tells you the true value of the asset, okay, at the current time you are reporting. Okay, so the net book value is more or less like, okay, you bought this car 24,000 Ghana cedis 5 years ago. Today it can't be 24,000 because the car has in a way deteriorated to some extent. Okay, so if you measure the quantum of deterioration or the depreciation and you less it from the original cost, the value you get is the net book value, or sometimes we refer to it as the carrying value. Okay, and this depreciation will be given to you in the question, so it's not something that is abstract. The cost as well will be given to you as well. Okay, then so these are the tangible ones, right? Then the goodwill, patent, copyright, investment, if you have them, you add all of them because they are all fixed asset. You get your total fixed asset. Then you move on to find the working capital, which is your current assets, as we saw, stock, debtors, prepaid expense, accrued income, bank, and cash. You less the liabilities, which are creditors, current one, creditors, bank overdraft, accrued expense, and income prepaid. So when you get the working capital and you add it to the fixed asset, then you get your first balancing figure, which is the net total asset. Then you go to the second section, which is very simple, financed by. So you have to always put the title financed by. You bring the capital first. You check if there was any additional capital. The question will tell you. And then the net profit or loss you made from your profit and loss account. Okay. If it is net profit, you add. If it is a loss, you less. And then you less drawings as well. Okay. And then finally, you add on any long-term liability to get the capital employed, which should always be equal to the net total asset. So that is the balance sheet for us. We need to remember this format, but I always advise students, take them one by one. You can begin with your fixed assets, okay, and then when you are comfortable, you go to the working capital. How you find the working capital? By listing your current asset first and your current liabilities to be deducted from it. Okay, so it's very simple. You just have to practice, practice, and practice. So dear professors, I think we'll take an illustration later. Okay, so for now, let's know the format, because if we take the illustration and we are not comfortable with the format, we may get confused. So let's take the format and digest it very, very well, so that when we take an illustration, well, for the next illustration, we'll begin from the trading account, profit and loss account, and finally the balance sheet. Before we end the session, I want to do this quick exercise with you. So normally when they give you the question, like this one you have here, the following was taken from the trial balance of XYZ Limited. So as you go through the trial balance, you have to know where each of the items would go. Is it going to the balance sheet? Is it going to the trading account, or is it going to the profit and loss account? You should know that. Okay, so let's test ourselves and see if we can score everything in this question. So I think we'll do it at random. Frank will pick the first one, Alexia will pick the second one and type in the chat, and I'll also pick the third one. And what we are going to do is when we pick the item, we agree whether it will be in the trading account, profit or loss, or balance sheet. I hope it's well understood. So plant and machinery, where would this be? Prof. Frank, you go first.
Say balance sheet.
A balance sheet, thank you, because it's a fixed tangible asset. Opening stock, Prof. Alexia, where would it be? Yeah, so in the chat, thank you. So it will be in the trading account. Excellent. Okay. So sometimes when students are working on this in exams, they take their time to do this kind of checklisting before they start. Okay, the next one, purchases. That is for me. That will go to the trading account. I think I'll quickly run through because I know you are very much convenient with it. Building will go to the balance sheet. Carriage inwards will go to the trading account. If I say one and you disagree with me, please prompt me and then let's discuss. Carriage outwards will go to the profit and loss account, so the P&L. Wages alone will go to trading account. Sundry debtors will go to the balance sheet. Salaries, I'm confused. Salaries will go to the trading account. Please, do you agree with me on that?
Yes, sir.
You agree that salaries will go to the trading account? Okay, let me see what Alexia says. Alexia says no. Frank says yes. Frank is doing boys things here. Frank's salaries will go to the profit and loss account because it's a general expense. Okay. Furniture is an asset, so we'll go to the balance sheet. Trade expense, that will go to the trading account. You remember when we said when you get your cost of goods sold, you add trading expense. So this one is specifically trade expense. Discount on sales. Discount on sales is discount allowed, right? So that will go to the profit and loss. Advertisement will go to profit and loss. Bad debt, profit and loss. Drawings will go to the balance sheet. Insurance, profit and loss. Bank balance, balance sheet. Sales, trading account. Commission. So here, commission, you have to be careful because the balance is at the credit side. So this is commission received. So it's an income, will go to the profit and loss account. Interest received, profit and loss. Creditors, balance sheet. Bank loan, balance sheet. Discount on purchases, that is also discount received, go to the profit and loss. Capital, go to the balance sheet. Okay, so you have to do some of these exercises, okay, just so you know where to take each item. Is very, very important. Okay, so that's why I'm doing some of these things with you. And listen, there's a sure way to getting these concepts, and that is by solving lots of examples. So I think our next meeting I'll share with you all the past questions for this particular topic, okay, so that you get familiar with the expenses, the asset, liabilities, and capital. Okay, and trust me, when you go through all the past questions, there's no expense, there's no asset, there's no liability that will come in your exams that you cannot identify. Okay, so thank you very much, professors. At this point, I think I'm wrapping up. So today we saw the profit and loss account. And we said this profit and loss account is used to determine the net profit or net loss. And this net profit or net loss is looking at the total operations of the business, i.e. the trading operations and other operations. So in the profit and loss account, we compare total income with total expenses, where the total income begins with the gross profit and then you add on other income as shown in the format. So the gross profit, we add other income to get the total income, and then we less the expenses. So we went through some list of expenses. You should be expecting okay, where are my expenses? Okay, I can't find that sheet, but I think we went through a list of them. So you appreciate rent and rate, salaries, insurance, blah, 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 blah. Okay. Then we came to the balance sheet, and we also appreciate that the balance sheet will pick the fixed assets, current liabilities, and long-term liabilities, and then capital. But in terms of the format, this is what you need to know. You always bring your fixed asset first. You go and work out your working capital, which is your current asset minus or less current liabilities. You add on to get your net total asset. The next section is you add or you show your capital, net profit drawings. You add on any long-term liability. So dear professors, I think that'll be all for today's class. If you have any questions, please ask me. If not, I will say bye-bye to you.